Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, I've kept you waiting longer than I meant to. My fiat job has had me busy all week, and I haven't been able to create the time to make a video properly. But I'm back, and we've got some things to discuss. Today we will talk about reactions to the FOMC. Some of it played out exactly like we thought. The Fed walking back most of what Powell said last week, what we think that means, and then we'll unpack some other factors going on in the labor market. So don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up and subscribe to the channel. I'm trying to make this my full-time gig, and I appreciate all of your support. So thank you for coming along with me. Now let's dig in. Since my last video, the markets have been pretty quiet. Bitcoin is currently around 22,800, consolidating in a little flag pattern here atop this range, which is actually pretty close to the 200-week moving average, right underneath it. And in the last video, we talked about how the S&P and the Dow Jones both had paused just underneath a pivot point from June, also near a couple of moving averages, and they seemed primed to consolidate atop their 382 fibs. That has been playing out so far. Over the last few days, you can see price action is pretty tight and confined. Now, something else we discussed last week was the Federal Reserve raising interest rates and the reaction by the market to the latest FOMC comments. We walked through several things Powell said in the press conference, and we talked about how the market had interpreted it very bullishly. And I thought that was a misread by the market. Well, what do you know? The Fed at least appears to agree with me, and they've spent the last couple of days, several governors doing the press circuit, trying to walk back the majority of what Jerome Powell said last week. So let's take a look at those comments. Here are several comments from a few different Fed governors over the last few days, and in them you find a narrative that seems cohesive amongst the governors and firmly in opposition to what Powell said off the cuff last week. If you recall, Jerome Powell last week said things like, "We believe that we've reached a state of neutral with interest rates." He also talked about not necessarily needing much forward guidance going forward, and he acknowledged some softening in the labor market. Well, the comment that really stood out to the market was the acknowledgement of being neutral. And they interpreted that to mean that future rate hikes will probably be less so, that their hawkishness will be muted, and prices started ripping. Well, over the last couple days, most of the comments out of Fed governors' mouths have completely contradicted Jerome Powell. They point out inflation has not decreased at all. They're not finished fighting high inflation. Some of them even went to say, we don't consider ourselves currently at neutral. Fed Daily here said we're not even at neutral yet. I'm not sure what the markets are looking at. The Fed must move into more restrictive rate territory. The Fed is still a long way away from backing off rate hikes. We have a lot of tightening in the pipeline, but we've yet to see it in data reflecting a slowing of the economy. So much of this is in line with what we talked about last week with my interpretation of the meeting, and it seems the governors are really working to massage market sentiment from what appears to be a deviation from what they hoped would happen. And I think that some of this makes sense if you think about it just logically. Let's dispense for a moment whether we think the Fed is knowingly lying, whether they're just ignorant, whether they're going to miraculously save us and avoid a recession. Let's just put all of that aside for a second and just think from a first principles basis. You say that you are focused on fighting inflation and that demand is too high. The market interprets some of your comments along the way to combating these problems as bullish, and it starts to rip. So what do you think those people who have taken this stance of being serious about inflation are going to do when they see a stock market ripping in their face when they're in the middle of tightening policy, when they're talking about demand being too high, when they're saying that we need to see a softening of the labor market and that we haven't yet? They're probably going to react negatively to a strong rally in assets. That has been my read on it. Whether that's right or wrong, whether they're doing the right thing or not, doesn't really matter from this perspective. They can't be taken seriously about fighting rapidly rising costs and an overheated economy and sit and watch assets rally across the spectrum. So in response to this, naturally, we see interest rates coming up. The yield on the 2-year has bounced pretty strongly over the last couple of days. The 5-year as well. The 10-year is now trying to break back above its little head and shoulders breakdown from a few days ago. We'll see what happens with that. But also the 10-year 10-year is at times less responsive to hawkishness and policy changes by the nature of it being a long-term interest rate. It's really the 2-year that is, by its nature and its design, required to respond more strongly to changes in policy. So it makes sense the 2-year is ripping more heavily. But what that does, since the 2-year is catching a stronger jump in yields, which means that it is selling off harder, it's pushing the 2s, 10s yield curve further into reversion. And when we look back through history, it is already near some of its most extreme points in history. This is from the 2000 market, and this other one back here is from March of 1989. We're approaching those levels of inversion on the yield curve for the 2-year and the 10-year treasury. So the market is all out of whack. It doesn't know what it wants to do. We've also seen oil breaking down. That's something else that's contributing to bullishness in the market. You can see it's finally now below the invasion price. It's broken down decisively below $90, which if you go back onto like a yearly chart, $90 is big time support up at the top of this massive range. Now, I do think that oil has some structural limitations on just how low it can go and remain down there. You know, where we have some real supply side issues that will continue to aggravate oil prices higher in the coming years, particularly if demand suddenly surges again. But there is evidence out there that gasoline demand is being pummeled by these higher prices and, you know, costs rising across the board. There was an article here on Bloomberg from August 3rd, just a couple days ago. Gasoline demand is below pandemic levels, at least for the time being, below the place that it was at this exact moment in 2020. Now you can see this pink line. This was the fall in the pandemic during the lockdowns. But in the summer, when things started reopening, gasoline demand surged. There's a little dot here now on the 2022 line. It's below the level from 2020, just barely. But it's indicative of declining demand for gasoline. So maybe that helps with inflation. We'll have to see as this plays out. But we do see bond yields rising again. And this language out of the Fed, when you look at their comments, I mean, just pause the video here for a moment and read all of these. They're very hawkish. They're clearly a bit of desperation coming out, I would say, in trying to tamp down the excitement in the market, because the market really is expecting a pivot. And I've made the argument to you guys. I believe a pivot is coming. I believe that they will be necessitated in having to reverse their policies at some point in the conceivably near future because the market becomes illiquid due to tightening and because of the excessive costs of debt. But that doesn't mean that they can't push this and push this and push this till the very last moment. I don't believe, and I have not expected at any point, that they will simply walk out from their meeting at Jackson Hole and say, you know, we've looked around and we've decided that things look kind of bad and we're going to back off. That's not their history. That's not what they do. They usually hike until they're forced to reverse, and they will parrot their intentions up until the final moment, even when the market starts to sniff out the bullshit. So while we're waiting on this little hiatus here, we thought we would have a break. You know, I said in the last video, it was possible we'd get a reprieve from all of this Fed jabberjawing, from all the market volatility that reacts to the things they say. But, you know, they ditched forward guidance for about 5 days. And then they came out after they saw the rally and they decided, nope. We've got to tell these market boys to chill out. So they came out on Tuesday, Wednesday, and Thursday of this week, all guns blazing with hawkishness once more. And something else that is stoking the fires of them possibly continuing on this path of raising interest rates is that the jobs report came in today and it was hot. Now, I'll explain here in a moment why there is some weakness in the jobs report. However, the headline number was 528,000 new non-farm payroll jobs. That is a huge number. It's like twice what the market was expecting, and it suggests that the labor market still has outsized demand related to the amount of supply of workers. There's far more job openings than there are people willing to work in current jobs with current wages. Now, I mentioned there were some things about the job report I wanted to talk about. Now, everyone's excited because the non-farm payroll number has now jumped back over where it was in 2020. In 2020, the high was 152.5 million. We are at 152.53 million. So we've jumped up just a little bit over the 2020 high. This has got the market very excited. You can see strong growth on non-farm payroll. Now, the jobs report is two different surveys. There's the establishment survey, which shows non-farm payroll payroll right here. Then there is the household survey, which is sent to a different group of people, and it includes a few more job types than are included here on non-farm. But the reason I want to talk about this is because there is a weakness that exists in the labor market, and I don't think it gets talked about quite enough. If you recall from one of my videos last month called Whistle While You Work, we talked about demographic changes in the United States, long-term, big picture shifts in the age makeup of the population, and how that would affect labor going forward, and how we've got a growing population of people at retirement age, because we have the boomer generation, which is the largest generation in US history, living longer due to advances in medicine. We also have declining fertility rates, so we're not backfilling the population with as many young people as we did in the 40s, 50s, 60s, and before. All of those combine to create a very different labor force makeup now and over the coming 20, 30 years than what we had in the generations before. I highly recommend you go watch that video if you'd like to learn more about what I'm talking about. I'll leave a link in the description below. But let's focus on the jobs report from today. What I've got on the screen are 3 different lines, and they represent 3 different measurements of the labor pool. The blue line is the total sum of people employed according to the household survey. In orange, the labor force, which is all employed people and all people who have filed for unemployment in the last few weeks. So they are participating in the labor force even if they don't have a job. The red line is non-farm payroll. That's the number we were just talking about, having broken above the February 2020 level. Now, what I've done here is I've compared all 3 of these lines, the employed totals, the labor force total, and the non-farm payroll number. I have compared them to the not in labor force number. So people who are not in the labor force are folks like retirees, military personnel are not in the labor force, federal government employees are not in the labor force, and also people who are not working that haven't been looking for a job and haven't filed for unemployment in the last few weeks. Those people just aren't counted as part of the labor force. And the reason it's important to look at the number of folks not in the labor force is because it is changing. As a result of those demographic shifts that I talked about, that I encourage you to watch the other video about, we're seeing a growth of the number of people not in the labor force who have no intention of working. What I consider as no desire to work or no intention to work are people who fill out the survey that they are not in the labor force, they do not want a job, and they are not marginally attached. They're not displaced. There isn't some reason that they were unavailable to work. They just simply have no intention of looking for a job. That's mostly retirees, but there are some growing portion of Americans that fit that description over the last few years. So the people who are not working, who don't intend to work, who aren't seeking work, who we could basically consider them retired, no matter what age they are, that population you can see has been growing over the years. It really took a jump around 2010 when the boomer generation began retiring, 65 years after the end of World War II. We saw a big jump, started to level off here in the middle 2010s, and that value is up here now around 57%. So that means that the portion of people who have no intention of working is more than half of the size of the actual labor force. And when you look at the working population compared to that labor force over the last few months, they're going in different directions. So we talked about how non-farm payroll has been shooting to the moon, and this has the Fed talking about labor strength. It does represent a form of labor strength. It represents jobs being filled. However, when you compare that number, non-farm payroll, to the growth of the not in labor force population, and that population is essentially growing at an even clip to non-farm payroll. So this tells a really different story. You know, we've got this one line here saying, wow, look at all these jobs coming back. Let's just forget about the fact that we've lost 2 years of job growth, of this line going straight up for 2 more years, and that it should be way up here above off my screen somewhere, but it's not, it's right here. Let's just forget that for a moment. That number is growing at an almost comparable pace to the growth of the portion of population that isn't working and is not unemployed. If you look at the employed totals, which is the household survey, which counts more than just non non-farm jobs. It also counts agricultural workers, and it asks a different portion of the population about their job prospects. That number has been rising at a lower pace than the growth of not in labor force. That's why you see this line coming down. That means that the amount of people who aren't looking for work and who aren't filing for employment has been growing at a faster clip than the number of folks answering "I am employed" on the household labor survey. It's a similar trend here when you just compare labor force to not in labor force. The growth since March has been to the downside. So what this is telling me is that while we do have some strength in labor, we're seeing jobs being filled. At the same time, we're seeing people leave the labor force. And those people, many of them will not come back by the nature of the demographics of the population, of the aging population. And many of those people, they're retired. They have no desire to work again. So we do see strength in labor, but I think that some of this disconnect may create undesired or unexpected results when the Fed continues tightening policy over the next couple of months. Because these job numbers just came out this morning, and they came out after all of this tightening and all this jabberjaw walk back that we talked about over the last few days. They've now been given, they meaning the Federal Reserve, have been given a lot more fresh ammunition to begin being hawkish again. The one note that we could say is they don't have a meeting until September. A lot could change between then and now. A lot has changed just since they had the FOMC last week. We will get a CPI report next Wednesday. That's something important to keep an eye out for. And I think that over the next few weeks, we can watch how the market digests this information. We can see how some of the other economic data comes in. The PMIs have been coming in. They're starting to roll over. Maybe we'll do a video about that soon and unpack that a little bit more. So we do still have a lot of economic data deteriorating over time as it rolls in month by month. But that doesn't mean the market has to go straight down. It doesn't mean that we can't just continue to chop around in a range. But I really do believe there is a disconnect with the changes going on in the labor force and expectations of performance for the labor market. We have record low unemployment, and still the growth of the not in labor force population is outstripping some of our different measures of employment. And when you look at this trend historically, just to give you some context, these values only are falling historically when unemployment is rising, as people are being forced out of the labor market involuntarily. That's when we see this value coming down. That's when we see the not in labor force population growing faster than the employed group. And that makes sense. People are losing their jobs. And this trend is pretty steady all the way back to the 70s. But we've got it now. We've got declines now while unemployment is at historical lows. So there is something going on here underneath the surface that isn't fully being appreciated by those in Washington, by those at the Federal Reserve. And I think that it could produce some unexpected results. We may get to a point where all these job openings disappear at the same time that a bunch of jobs disappear. And it could happen more quickly than the Fed is ready for. We've talked about, you guys and me, we've discussed on this channel how when unemployment starts moving, it moves fast. It is not a number that creeps up slowly over time. What it does is it falls slowly over time and it rises mercurially fast. So the fact that the Fed thinks they can continue to tighten and that we can see a slight increase in the unemployment rate, while at the same time we're seeing a lot of people leaving the labor force. We've got data going in two different directions, right? We've got a strong labor force, but also a relatively shrinking one historically. So trying to marry those two up has been a challenge, to say the least. And I mentioned to you guys about how we may have gotten back to the same total of non-farm payroll that we had before, but the labor force as a whole is still far behind trendline growth. So here's a look at the labor force. So this includes the people that are employed and people that are unemployed. This is it over time. This red dashed line is the all-time high. And this blue dashed line up here at the top, this represents trendline growth. I took trendline growth over a 20-year period. I gave it a conservative value, and I posted a trend line. You can see the drawdown from the current all-time high in labor force is about 610,000 as of this number here. This is the June value. I haven't updated it for July yet. But as of last month, we were only 610,000 bodies shy of the high from before COVID. That's not too bad. But if you think about trendline growth over that period that we would have normally had did we not incur such a swift drawdown, we're over 3 million million shy. We're about 3.5 million shy of trendline growth in the labor force. So we are a long way away from returning to the kind of jobs market that we had before the pandemic. And when you think about the things we've been discussing, the changes to the demographics, I think it very unlikely that we will return there. Here's a look at true unemployed. So this counts not just people who filed unemployment, but also those who are considered marginally attached, and maybe people who want a job but weren't able to get one. That number of people is larger than the total unemployed population because it counts more groups. And when you look at it back through history, this is in total people, okay? This is not in a percentage rate. This is a total number of Americans. The value is at the 10-year low, which you can see here in red. It's literally sitting at it. And it's not very high up. It's only about 1 million shy of the 30-year low, which is from back here in 2000. So we have the lowest amount of people without work that we have had in 30 years, while at the same time we are seeing a growth in the number of people who have no intention of working. So there are some fundamental changes happening in the labor market that are going to disrupt expectations of how this data is going to play out. I won't know exactly how those play out. No one really does, but I share it with you so that we can be informed, so that we can talk about it, and so that you can have these things in mind as you hear these narratives play out in the media. When you hear that we added 528,000 jobs and that we broke above the 2020 high, remember that we are still significantly below the growth rate that we should have in the labor force over a long period of time. We are missing that growth. While at the same time, the number of Americans out of the labor force is growing at a comparable or larger pace than many of our employment measures. The labor pool is weakening, and at some point, based on the history of how unemployment rate reacts and how quickly it moves, I imagine it will snap, and we will see both job openings and jobs held falling. We'll keep an eye on the markets over the next couple of days. We weathered a pretty rocky week of economic news. Next Wednesday is the CPI report. That's when we'll find out if we got a lower than 9.1% print. The Fed's inflation nowcast thinks that we'll get 8.8%. So we are now firmly at the point of the shit show where an 8.8 CPI print will be spun as an improvement. So I hope you're all ready for that. Now, one last thing I want to mention before we wrap up. I'm often asked for recommendations on charting software. The software that I use to look at market data is TradingView. It's what you see on the screen for half of all my videos. And if you'd like to get your own account, I signed up for an affiliate link. I've left it in the description below, and you can get a discount. I think up to $30 off depending on the subscription plan you sign up for. So check that out if you're interested. And that is where we will wrap it up today, friends. I really wanted to dive into some of what's going on with the labor market. And there were even more charts that I could show you that I'll save for another video. If you have feedback, questions, or comments for me, make sure to leave them down below. I check out all of them. I'm sorry to have kept you waiting for so long between videos. I've been managing a lot of responsibilities with my fiat job and this channel. But I appreciate your patience and for your support. Make sure you follow me right here on Twitter at TXMCTrades. This is where I post a lot of my own thoughts and analysis, and you'll find out about other podcasts and content that I'm participating in. We'll give the markets a few days to play out, and we'll reconvene here shortly. So until we meet again, take care of yourselves, friends. Be kind to each other, and we will chat in the near future. Cheers, everyone.